Hi candidates, welcome to another session of manifested online classes. We are still continuing the topic of group accounts, and we are still discussing the various consolidation adjustments which are necessary when preparing the consolidated statement of financial position. And basically we said we have 5 key consolidation adjustments excluding computation of goodwill, excluding computation of group retained earnings and also the non-controlling interest. And so far we have discussed around 4 key consolidation adjustments. Adjustment relating to amount of intercompany debt, adjustment relating to fair value exercise, adjustment relating to unrealized profit on inventory, and also adjustment relating to intra-group sale of non-current assets. So I want us to discuss on the last one, and then from there we are going to illustrate. We are going to look on an illustration so that we can be able to understand how to deal with the goods in transit specifically in preparing the consolidated statement of financial position. So we have goods in transit, abbreviated as GIT. So when talk about the goods in transit, we have said that these are the goods which are sold by one group member to the other. For example, goods sold by the parent to the subsidiary, and then those particular goods are sent to the buying company or to the purchasing company almost at the end of the year, meaning that when the year is coming to an end, the buying company will not have received and accounted for those particular goods. So those particular goods, therefore, we refer to them as goods in in transit. Like in this case, we can be told that the parent company sold some goods now to the subsidiary, and then these particular goods were sent now to the subsidiary almost at the end of the year. And therefore, when the year is coming to an end, the buying company, which is now the subsidiary, will not have received and also will not have accounted for those goods, particular goods. So therefore, these particular goods here, we say that they are goods in in transit. Goods in transit. So which adjustments are required as far as these goods in transit are concerned? So here we have a number of consolidation adjustments. Number one, these goods in transit should be recognized in the books of account of the purchasing company. Or basically we can say the first adjustment in relation to this particular good is to recognize the goods in the books of account of the buying company. So buying company, like in this case, the buying company will be the subsidiary. If the goods now were sold by the subsidiary to the parent company will be the buying a company. So that is the first thing you need to do. You need to recognize those particular goods in the books of account of the buying company. How do you recognize them? One, you recognize them by debiting the inventory of that company, or in other terms, what we do is that we debit those particular goods in the group inventory. In other terms, the goods in transit should be added to the group inventory. Inventory. Number two, those particular goods will also be credited in the payables of this company, because these are goods basically which were bought on credit and not yet received and accounted for this company. So basically we should debit its inventory and then we credit the trade payables because the goods were bought on credit. So therefore we add the goods now to the group inventory, and then we also add them to the group payables. That is purely to recognize those particular goods. Number two, these goods will also give rise to two other adjustments. Number one, they give rise to something called the unreleased profit, and also they give rise to something called the intercompany debt. Intercompany what? Debt. And therefore, what we do there is number one, we have to compute the unreleased profit on all the goods, because all these particular goods will not have been sold, meaning that the profit which was reported by the selling company, the entire amount of profit will not be realized, because the goods will not have been received by this company, meaning that the goods will not have been sold to that parties. The entire profit will not be realized. Number two, this company will not automatically have paid for those particular goods. That give rise to amount of intercompany debt. So therefore, the other thing we need to do here is to determine the unrealized profit on those goods, the unrealized profit on those goods, or basically the unrealized profit on that inventory. And the unrealized profit in this case will be equal to the goods in transit. So we compute the unrealized profit based on the goods in transit, based on all goods, times the gross profit margin. So this unrealized profit on inventory, the normal consolidation adjustment applies. So this unrealized profit, we less it from the group inventory, and also we less this from the retained earnings of a selling company, retained earnings of selling what? A company. And the other adjustment, number three is that this particular goods will also give rise to amount of intercompany debt. Will give rise to amount of intercompany debt. So basically that amount of intercompany debt, the amount of intercompany debt will be based or will be equal to the goods in transit. So this amount of intercompany debt, number one, we less this from the group receivables and also from the group payables. Less that from the group trade receivables and also from the group trade payables, group receivables and the group trade payables. So therefore, we have those three key consolidation adjustments which are made relating to the goods in transit. Relating to the goods in what? In transit. First of all, we have to recognize those particular goods in the books of account of the buying company by debiting them in the group inventory, group payables. Then they will give rise to unreleased profit, which will be equal to goods in transit times gross profit margin. Less that from the group inventory, less it from the retained earnings of the selling company. They will also give rise to amount of intercompany debt, which will be deducted from group payables and the group what? Receivables. Yes. So I think with that particular knowledge there, we can look on an illustration so that we see how this adjustment is, or basically which items are adjusted with these particular goods in transit. So we look on an illustration, and our illustration reads that B Limited acquired 60% investment in H on 1st January 2020 for shilling 720,000 when the retained earnings of H was 300,000. The statement of financial position of the two entities as at 31st of December 2023 are presented below. So we have the statement of financial position for B Limited, H Limited. Under non-current asset, we have PP, property, plant and equipment. We also have investment in the subsidiary. We have current asset. Under equity, we have share capital, retained earnings, then non-current liabilities, current liabilities. We have additional information. Number one, you're told it is a group policy to value non-controlling interest at fair value at the date of acquisition. The fair value of non-controlling interest as at 1st January 2020 was 480. Number two, you're told on 28th December 2023, that is some few days to the end of the year, H Limited sent goods at an invoice price of 700,000 to B, which B Limited neither received nor recorded until 5th January 2024. H Limited had marked up these goods by 25% on cost. 25% on cost. Yes, so we have this particular illustration here. And recall what we said is that once you come across a question for group accounts, the first thing always you need to do, number one, is to come up with a group structure. So where do we have that information about the group structure? Paragraph 1. We are told B Limited acquired 60% of the 60% investment in H Limited on 1st of January 2020. So mean that as per this information, this will be our parent. This is our subsidiary. That is the date of acquisition. Yes, and then in that first paragraph, we are given the purchase consideration paid by the parent 720, and then the retained earnings of this company at the date of acquisition. And I think we can use that information to compute the goodwill arising on acquisition. Goodwill on acquisition. And which method are we supposed to use here? We are going to use the full goodwill method as per the information provided in note 1, because in note 1 you're told is a group policy to value and controlling interest at fair value. So in that case we are using the full goodwill method based on that information which are given there. So we need to have two columns here. So what do we start with? We start with the purchase consideration paid by parent company, which we have in paragraph 1, which was 720. And then to this we add NCI at fair value, which is in note number 1, sentence 2, 480. This will give us 1200. And then to this we less the fair value of net assets acquired. So here what we need to do, we need to compute the fair value of the subsidiary company, net asset on the date of acquisition, which is equal to the ordinary share capital of the subsidiary plus all pre-acquisition reserves. And actually, we get that from the balance sheet of this company, the statement of financial position of this company, specifically at the equity section. So the first item we are given there is the ordinary share capital, which is 500. And then in this case, we have said you also need to check, was that company having any share premium? You include it there? No. The other item of equity which we have there is the retained earnings. But remember, in this case, we have said we take the retained earnings, what we consider here is the pre-acquisition, the retained earnings which of the subsidiary company at the date it was acquired, which are given in paragraph 1. Paragraph 1, we are told at the date this subsidiary was acquired, its retained earning was 300. And also you have to check whether this company devalued the asset on the date of acquisition. Do we have such information? No. So what we do, we get the total here, which is 800. And because you're using the full goodwill method, we are interested with the asset acquired by the parent, asset acquired by the subsidiary, 100% of this, which will give us 800. So we less that from the figure we have up here, we get 400. So this is now the goodwill. And actually that is a full goodwill. The goodwill of the parent, the goodwill of what? NCI. This one will be recognized in the consolidated statement of financial position as what? As one of the non-current assets. So I think we are done with the additional information number 1 and also the information given in paragraph 1. Then in number 2, we are told that on 28th December 2023, these are some few days to the end of the year, actually 2 or 3 days to the end of the year, we are told that H Limited, which is now the subsidiary, sent some goods at an invoice price of 700,000 now to B, which B Limited had neither received nor recorded until 5th January 2024. So those particular goods which were sent by the subsidiary, not yet received and recorded by the buying company, that is B, we refer to them as goods in transit. goods in transit. Now, which adjustments are required as far as these goods in transit are concerned? So, number one, those particular goods had a value of 700,000. So, this 700,000, number one, we have said we do what? We add this to the group inventory. Actually, is to recognize those particular goods in the books of account of this, because if this company had received those goods, they were supposed to be debited in the inventory and then credited in payables. So this one will be added to the group inventory and also added to the group payables, the group trade payables, an amount of what? An amount of 700,000. And then number two, this particular goods here will give rise to a unrealized profit. So the unrealized profit you have said will be equal to goods in transit times the goods times the gross profit margin, times the gross profit what? Margin. So the goods in transit 700,000 or 700 times the gross profit margin. Are we given the margin in that case? No. We're given the markup. We're given the markup. And basically I said if you're given the markup, then you can be able to compute the margin. So the markup in that case is 25%, which is the same with a quarter. So mean that the gross profit margin will be what? 1 all over 5. 1 all over 5. So this will be 1 all over 5. 700 times 1 all over 5, or basically divided by 5, which will give us 140. So this is unrealized profit. So this being unrealized profit, number one, we less this from the group inventory, and then we also less it from the retained earnings of the selling company. Less it from the retained earnings of the selling company. The selling company in this case, if you check on note number 2, we are told that H Limited sent. H Limited is the one which sold some goods now to the parent. So we are going to less that from the retained earnings of H. Then this particular goods in transit, we have said that they will also give rise to amount of intercompany debt. So amount of intercompany debt in this case will equally be 700,000. This will be deducted from the group payables and also deducted from the group receivables. Group payables, group what? Group payables, group receivables. I think those are the adjustments which are required as far as the goods in transit are concerned. So this is very, very important. You can see it give rise, it has a number of adjustments, unlike the other key consolidation adjustment. So I think with that we can prepare what is required. B, group consolidated statement of financial position as at 31st of December 2023. So we just need to have a single column here. And we start with the non-current assets. So for non-current asset, we start with the PPE. PPE, we take those of the parent 23 plus 19. Do we have any adjustment in the group PPE? In the group PPE, no. So we get the total here, which will be 4,200. 4,200, I'll confirm that. The other item which we also include here is the Goodwill. This one, 400. We get the total, and then we take the current assets. Current assets. So for current asset, we take those of the parent, that 340 plus 1790, and then we also have some adjustments here. Remember, receivables, inventory is part of this, is part of the current assets. So we have these goods in transit, which you have said should be added to inventory, which is part of this. So we add 700. We add 700 here. So then we also have this unrealized profit, which is how much? Which is 140. So we less it from the group inventory, which is also part of this. And then we have this amount of intercompany debt, which will be deducted from the group receivables. Receivables is still part of this. Yes, so we get the final figure here. So maybe first of all, you can confirm this 2300 plus 1942. Okay. What about the current asset, that 340 plus 1780 plus 700? Actually, this one will just cancel off. So minus 7 minus 140, which will give us 4990. This one will be 46. We get the total assets. Total assets 5590, and then from there we proceed record equity. So for equity, we start with the share capital. So by now you need to remember that for share capital, we only include the share capital of that of the parent company only. We don't combine the share capital of the parent and that of the subsidiary. Then from there is something we need to include here, that is a group retained earnings. This one needs some computation. And then something else called the non-controlling interest. Non-controlling interest, we're also going to compute on that. And then from there we have non-current liabilities. For non-current liabilities, we have 350, no adjustment here, plus 290, which will give us 640. And then we have current liabilities. Current liabilities, we have 1580 plus 1100. And then there are a number of adjustments here affecting payables. So to the payables, we are going to add 700. We add 700. This do not affect payables. We also less this 700. We also less this 700. Yes. So we add this one, and then we less the amount of intercompany debts. That is okay. Basically, though the two figures will cancel out each other, no problem with that. So we have 1580 plus 1100. Then this and this will cancel out each other. So that will give us 2680. We get total equity and liabilities. So, but before we do that, automatically you have to compute two items here. You have to compute two items here. The two items we need to compute include the retained earnings, the group retained earnings, and the non-controlling interest. Yes, so let's start with the group retained earnings. So for the group retained earnings, we need to have two columns here. For parent company, which is B, for the subsidiary, which is H. So what we take into account here, or what we start with, is the retained earnings as given in the statement of financial position. The retained earnings of the parent is 3430. That of subsidiary is 800. But for the subsidiary, we need to exclude the pre-acquisition retained earnings. We need to deduct pre-acquisition retained earnings, which was used in the computation of Goodwill, such that we are left with the post-acquisition 3430, 1500. And then from there, we need to check the various items affecting the retained earnings of either B or the H. So this Goodwill, that will not affect this one, but we have this unreleased profit. And actually this unreleased profit always, it is important to note that this unreleased profit by selling company. So the company which sold these goods, as per the information given in note number 2, was H. This was unreleased profit, therefore by H. So we have unreleased profit on goods in transit, which is by H. of how much? Of 140. So we less it there. That's what we said. Less that from the retained earnings of H. Actually, that is clearly indicated there. Do we have anything else? Anything else? I don't think so. We don't have any other. So we get 3430. We get 13 what? 60. Let me confirm that. 1500 minus 140. Yes, so then we get the group share of this. 100%, 60%. 100% and 60%. So 100% 3430, 60% 816. So we add the two figures, which will give us 4246. So that is the group retained earnings here, 4246. 4246. Yes. So then from there, what we need to do next. So remember, you have seen that that will give us 4246. So then from there we need to proceed and we compute the NCI at year end. NCI at year end. So the NCI at year end, remember, this is now the minority shareholders' share of the net asset in this subsidiary, in that subsidiary. So how do we compute that? We take the net assets of the subsidiary at the end of the year, at the year end, and actually we say that this is the same with equity, with equity. So how much is the total equity of H at the end of the year? It is a figure of 23. But also what we know is that the retained earnings of H is part of that. So therefore, anything which has been adjusted in the retained earnings of H also need to be adjusted here. And I think we only have this one, the unrealized profit on goods in transit, which is 140, and we need to less that from the figure we have there. And we have 23 minus 14, 140 that is, which will give us 2160, and then we get now the NCI share of this. NCI share of this, which will be 40%, which will give us 864. There is something also we need to add here, and that is the NCI Goodwill. So how do we compute the NCI Goodwill? To compute the NCI Goodwill, we take the NCI at fair value, that one, 480, minus the NCI share of net assets. NCI share of this net asset. NCI share of this net asset will be 40%. 40% of this, which will be 320. So we take NCI at fair value minus 320, which will give us what? 160. 160. So we add the two figures, 4, 2, 10. 20. That is 10 what? 24. Let me confirm that. 480 minus 320 plus 864. Yes, 10, 24. Then we add all that. So first of all, this will give us 5246. 5246 plus 1024 plus 640 plus 2680, which will give us 9590. Yes, 95 what? 90. So basically that should be the same with what? With the total asset. With the total what? Asset. So that is it, that what is required as far as that particular question is concerned. what we have been able to do there is to illustrate how to deal with what we refer to the goods in transit, specifically in preparing the consolidated statement of financial position. And basically that brings us now to the end of our discussion regarding this particular consolidation adjustment, and therefore it is very, very important for you to be able to understand how to deal with this particular key consolidation adjustment, specifically in tackling a question for group account. Anytime you come across a question from this topic of group account, mostly the examiner will test a number of these particular key consolidation adjustment. Like any question for group accounts, you'll come across an adjustment relating to fair value exercise, intercompany debt, and mostly the unrealized profit on on inventory, goods in transit, intra-group sale of non-current assets. They are not that very common, but equally they are also tested in some of the questions which the examiner will bring from time to time. So therefore it is very, very important for you to understand how we deal with those particular key consolidation adjustment. And actually you can only be able to do that by trying to go through what we have been able to discuss, and also try to look on the illustrations which we have been able to discuss. So therefore for today, or actually for now, we are going to stop at that particular point. So once we meet in our next session, we are going to look on how to prepare the consolidated income statement, specifically whereby the parent company has invested in a subsidiary, and also we do some illustrations regarding the same. So see you in the next session.